frankly, the H1 FY19 borrowing numbers and the accompanying news is frankly turning out to be a bundle of joy for now, at least for the bond market. Vivek Rajpal, he represents the fixed income group for Nomura. He joins us live. Vivek, good morning. Thank you for joining us. Vivek, do you think the rally in the bond market is justified and one can believe the government borrowing target for the first half, or do you think they could be forced to revisit that if crude spikes higher?
No, so, well, if you really see the bond supply calendar has surprised positively. Historically, we have seen 60% of the total total gross supply getting issued in first half of the borrowing calendar. But this time it's only around 50%. There is no reason for me to believe that they will not stick with this. In fact, I think the real positive surprise has been the distribution of tenors. So historically, India has seen most of the bond supply occurring in 10-year to 14-year segment. But what they have done is they have now shifted supply to the front end of the curve, where I think demand is much more. So it's a positive surprise, and I think bond markets are reacting rightly to the announcement.
R. Shivakumar also joins us. He is with Axis AMC. He represents the fixed income group there. Shivakumar, good morning. Thank you for joining us. Do you think now the bond yields have peaked out for a really long time?
Clear.
Shivakumar, is my voice reaching you? I don't think Shivakumar can hear me. Is my voice reaching Shivakumar? It is not. Vivek, back to you. What do you make of government's, proposal or plan to come out with low duration instruments, especially 1 year and 4 year based?
So, absolutely. I think they have shifted their supply from 10 to 14 year segment to the front end, which is 1 year to 4 year part of the curve, as well as 5 year to 9 year part of the curve. I think this is a good move, because the reality is that Indian bond markets have relied heavily on the domestic bank demand historically, who have been buying 10-year to 14-year part of the curve. But now that investor class is shifting. That investor class is shifting away from overall Indian bond markets' reliance on domestic bank demand is reducing, and the new investor class is emerging, which is FPI. And if you really look at what FPIs buy, FPIs typically buy in the shorter end of the curve. So their favorite part of the curve is 4 year to 9 year part of the curve. And hence what government has done in terms of shifting supply from 10 year to 15 year to the front end is actually a very wise move, as it caters to the new reality that the investor base is shifting for the Indian bond markets.
A good 25 basis point reaction is what you're seeing on the 10-year bond yield, while the currency continues to hold out at 4-month highs right now, or rather 4-week high, I stand corrected. 64.74 is where the rupees. The yield, of course, is seeing a big reaction this morning. But Sivakumar is back with us. Sivakumar, morning. Can you hear me clearly? No, I don't think we're still getting the audio to him. But just, Vivek, on the point that you were making, I wanted to understand what could be the impact of the H1 borrowing plan on banks, because PSU banks earlier had excess SLR. Do you see PSU banks getting transformed because of this move?
Actually, that's a very good question. In fact, this is exactly what I am also watching. I think there are two reasons why banks are missing from buying demand. Number one, clearly the starting point is very high in terms of excess SLR in the system. and that remains to be the case. That's a stock level thing, and it doesn't change very frequently. But the second aspect was that bond banks have lost money because of rise in yields, and hence that led to their reduction in risk appetite, and that led to a reduction in bond demand from them. So, but what we are seeing now is a rally in the bond markets. This can bring back at least some of the demand from banking system. So it may well turn out to be a much more virtuous cycle. Though I don't think only a 20-25 basis point of a rally is sufficient to do that. But I want to say is that a decent supply management in the bond markets, which seems to have been playing out with a combination of demand from FPIs and some other positive news on India, all of this can well turn into a virtuous cycle for Indian bond markets. But this is something which we have to see over time. As of now, one can safely say that Indian bond yields have peaked. How much they rally from here on is something that will depend on the other set of announcements as well.
Right. Vivek, just very quickly before we let you go, with crude at 70, all eyes are also in inflation. Would the H1 borrowing plan have any impact and ease inflation thereby?
No, I don't think it works the other way around. I mean, of course, crude is a worry. 70 crude at 70 is something which is expected to make Reserve Bank of India incrementally hawkish over time. But what I want to say here is that Indian bond markets haven't seen so much of a spread versus repo rate historically. I mean, I personally think that at 6% repo rate and current level of bond yields, the spread is too high, and the valuations are too attractive that bond markets can easily absorb the incremental hawkishness from the Reserve Bank of India.
Thank you for joining us and sharing your opinion on the move which is taking place right now in bond markets. And he clearly says that, you know, probably there is more downside which is required for a scenario to change completely. And my observations from derivatives are also revolving around this, what's happening to bond markets. Now, yes, we are talking that the treasuries would, bank treasuries would gain because of falling yields. But, you know, in last 2-3 quarters, we have seen that how NBFCs have underperformed, and the reason which was given for that underperformance is that the business model is not, you know, equipped to these higher interest rates. And if interest rates are coming down or yields are coming down, I think that pocket would benefit. And unlike PSU banks, these stocks are not rallying because of short covering. Case in point, Ujjivan, 7% rise in open interest and price also went up. If you look at, you know, on charts, then 335, 340 has acted as a strong support zone, and longs were also formed yesterday as well as in previous trading sessions, and they're still intact. So I believe this is one stock which is poised for, you know, some decent upside, looking at the way bond yields are moving and formation of longs as per statistics. The other stock in same space, and which, you know, our experts have also been talking about, is Bajaj Finance. Now here too, you know, 5% rise in open interest with formation, 5% rise in OI, and prices went up. So these are not short covering rallies, these are formation of longs, and basic of derivatives is that stocks which go up because of formation of long position, strength lies there and not in short covering. And volumes in both the segments for Bajaj Finance were quite high, and stock is light in terms of open interest. So all those shorts which were created since last 3-4 months, I think those have got squared off, and stock is probably poised for decent upside, Aisha and Nikunj.